So we want to thank you all for coming to our first series in our credit building. We are so grateful to be here and be a part of this coalition to put 25,000 Black families in homes. We came to fruition about a month ago. A bunch of you probably have seen our masterclass from February 27th, where we began the process to getting you all mortgage ready and credit ready to be able to purchase a home. Although this is a program we have focused primarily on African-American families, it is open to everyone. Our statistics show us that the Black home ownership rate is at 44%. Why that is very disturbing is because it was at 44% prior to segregation. And we know that the assets and the wealth in Black households primarily come from home ownership. And so if we are only at 44%, then this is a public crisis right now, for not just the African-American community, but for the whole country, because we are also known to be the biggest consumers and spend trillions of dollars in products and shopping. And so we want to make sure that we make smarter purchasing decisions and that we focus on homeownership so that we can build our communities up, so that we can build generational wealth and be able to pass that on to our children. And in particular, you know, mom's house and grandma's house and great grandma's house needs to be protected. And a lot of times in our community, we buy the home, but we don't protect it. And a lot of times when grandma dies, it goes into probate situations and we can lose our wealth that way. So we are here to not only put 25,000 Black families in homes, but to also preserve our communities and our homes that we have within our family already. So along the next 8 weeks, you will see us have multiple events. In addition to the one-on-one counseling, we will have multiple events to focus on credit, mortgage hurdles, including past bankruptcies, foreclosures, student loans, which is a huge issue within our community as well. If you all are interested in the stats, you can go to NAREB, NAREB.com, look under who we are, and you will see the state of housing in Black America. NAREB was founded in 1947 because at the time, African-American real estate professionals could not be members of the National Association of Realtors. So our fight is for democracy and housing and equal access to credit for all. So with that being said, I am Shantae Patton. I am the Regional Vice President for the National Association of Real Estate Brokers, branch manager and housing counselor for NID of Southern Nevada, and a realtist for the last 17 years. I want to thank you all for being here and thank one of our coalition partners, Homie, who has spearheaded this campaign for homeownership, and that would be Elias Benjaloon too. So with that, I am going to say thank you to all our coalition partners, Nevada partners, Neighborhood Housing Services of Southern Nevada, the City of Las Vegas, the State of Nevada, and NACA, and as well as SCE Federal Credit Union, who has a great program specifically for understanding your credit. So with that, I would like to turn this over to Emily with SCE Federal Credit Union to kickstart this off and get us one step closer to putting you all in homes. Thank you so much.
Thank you, Shanta. I appreciate the introduction. Good morning, everybody. Happy Saturday. It is the weekend. I hope everybody's having a good one so far. We're going to jump right in. I want to start talking immediately about credit. We do have quite a bit to cover. So the idea here is that the information that we share today can be helpful and can serve as a resource to you. We are a credit union, but we're not here to sell you anything. We're a not-for-profit. So we genuinely just want to be a resource to you. So I hope that this is helpful. And we hope that if you have questions, I'm going to leave some time towards the end where we will have a question and answer time. So if you wouldn't mind, please keep yourselves on mute. And as we're going through this, there probably will be times where I want to engage with you, where I'm going to ask questions and then I'll get quiet. And it's not because I want you to unmute yourself and start answering, because with this many participants on this webinar, that could get a little nuts. So what we're going to do is I'm going to keep the chat open, and I'll be looking for some of the conversation as we're going through some of these things. It's helpful to kind of understand where we're already at in our thinking in terms of this topic, and then start to address some of those things. And then if you have a question, maybe write it down. And at the very end, if I never got to that, if somewhere in this content we never covered the answer to your question, you're going to have plenty of time to talk about those things at the end, okay? So let's go ahead and dive in. Today we're going to talk about understanding credit. And there's a lot of different things that we want to understand about this topic. So let's go through it. What is the purpose of having this conversation? Is credit something we absolutely need? There are some financial counselors out there that will say you don't want to use credit, you don't need credit. The idea behind that is so that people don't get into debt. So I understand the thinking of that, but let's be realistic here. If you or I do not have $300,000 sitting in our account, how are we going to purchase a home, right? Then we need credit. Not to mention there are other purchases that kind of require credit. For instance, if you are looking to rent, even if you're going to rent a property, they're going to want to run your credit most of the time. Even young people, when they're getting out of high school, if they want to go get a cell phone plan of their own, a lot of times they'll run credit to see like what their payment history is like, to see if they're going to charge that person more up front. Because of risk. So credit actually is used often. So I do believe it's important. I do believe it's something that we need. Most people definitely need credit. How can having good credit affect us? How can having bad credit affect us? And what should you know about lenders who say that they'll help you even when your credit is bad? So there's a few things here that we want to go over. So let's talk about that for a minute. So having good credit, how can that affect you, and how could bad credit affect you? So I think it's important to note that when you have good credit versus bad credit, or vice versa, you're looking at a difference in monthly payments. You're looking at a difference in interest rates. You're looking at a difference in how much you're going to spend overall on a particular item, whether that be a house or whether that be something you bought with a credit card, or whether that be a vehicle that you purchased and you got an auto loan. These are the types of things that you want to think about. So how can that affect you? We had a gentleman come in who had, he came in for like a counseling session, and he made really good money, but he didn't have the best credit. He had a very sad situation, actually. This gentleman came in because he just didn't know what to do. Again, he was making good money, but he was struggling. And a big part of that was because of just some decisions he made during a very difficult process. He had been spending a lot of his money on rehab for his adult son. His son was an addict and he was trying to help him. And so he was spending this money trying to get him on his feet, get him through rehab. He got him a condo, got him a vehicle, all of these things. And then sadly, his son ended up overdosing and he passed away. So then this gentleman, in his grief, went and purchased some more things to, I don't know, make himself feel better. I think we all do things in our grief that we don't always understand. But as a result of doing this, after he had already spent all of this money and used his credit to do these things for his son, but when he went to go make these other purchases, his credit was already kind of shot. So now he had these two vehicles. One of them was at a 19% interest rate, and one of them was at a 17% interest rate. Now, for an auto loan, that is very high. So when this man came in, he was spending about $900 a month on one vehicle and about $1,100 a month on another vehicle. That is a lot of money for a car payment. Why was it so high? Because his interest rate was so high. So we wanted to help him. We couldn't even refinance the vehicles because even though his payment was high, so much of that payment was going towards interest. So the principal of those auto loans was not coming down very much. So now the value of the vehicle was a lot lower than what he owed. I hope that makes sense. So what does that mean? That means he got himself into a very difficult position where we couldn't even refinance these loans at a lower interest rate, even if his credit was better, just because of the value of the vehicle. He got into trouble there and now he's stuck. He is now stuck making an $1,100 a month payment on a vehicle that he no longer wanted and could no longer afford. If he had had better credit and a lower interest rate, we'd be talking about maybe a $600 payment instead of $1,100 payment. So even though that's still high, the point that I'm making here is that he'd still pay the vehicle off in the same amount of time. It would have been the same term, which I believe was 60 months, 5 years, but his payment would have been tremendously less, right? We're talking about a $500 difference. So yes, having good credit can really, really affect us in a positive way, or negatively affect us if we have bad credit, because it will change our payment amounts. It will change the amount of interest we pay. Another thing to think about in terms of good and bad credit is what we can get approved for if we're in a difficult situation. So let's talk about that for a minute. Right now in America, over 50% of Americans are paycheck to paycheck. So that means they're not saving. So if they're not saving, and if you find yourself in that boat, I'm having a hard time saving, it's difficult, we've got these expenses and this income, I understand. But when you are paycheck to paycheck and you're not able to save, then what happens is emergency situations come, and then you have to figure out where to get the money. Now, if you have good credit, you could get a personal loan if you needed to. If you have good credit, you could use a credit card if you needed to. For instance, let's say you're paycheck to paycheck and someone in the family that lives across the country needs you. Or even like if a loved one passes away and you have to get to the other side of the country, but you don't have any money for this emergency expense. It's a $500 round trip ticket or something like that. How are you going to afford that? Over 40% of Americans say that if they had a $400 expense, emergency expense, they would not have it in their account to pay for. So when these types of things happen, where do people get the money? I'm gonna open this up to the chat. So guys, where do people get the money? If you are paycheck to paycheck and your credit isn't the best, so now you don't have access to get a small loan, you don't have access to get checking account. Maybe you'd want to ask for, okay, I'm seeing some answers come through. Maybe you want to ask for family, but maybe you have too much pride, or maybe your family doesn't even have it. Where do you go? Where do you get the money? I'm seeing a lot of answers. Most of them predatory lenders. Somebody said borrow from family, use credit cards, dollar loan center, payday loans. Short-term, high-interest payday loans, sell items. That's one. Car title loan, sell something. Thank you for the engagement, guys. I appreciate it. All very good answers. Yes, sometimes people will sell items. Sometimes they'll try to borrow from family if they can. If you haven't maxed out your credit cards and you're able to use some money there, yes, some people will turn to credit cards. But the one I'm seeing on the chat the most is the payday loan centers. Guys, do you know that we have more payday loan centers in Southern Nevada than we do have McDonald's? That is a real statistic. We have more payday lenders than we have McDonald's. Why is that? Does anybody know why we have so many payday lenders in Southern Nevada? Any ideas? I'll look through the chat. Gambling, Casinos, because they make good money. There are more payday loans in the Black community than there are banks. That is very accurate, and I will address that in a moment. Gambling. So it's a few things. Gambling is one of them. People who have gambling issues, if they live in Las Vegas, probably not the best place for them to be living, but now they have access to so many casinos, right? And so if they need additional funds or they've gambled away their money, now they're going to have to go get a payday loan. So yes, that is one of the reasons. One of the biggest reasons we have so many payday lenders here is because they can make good money here. If we look at it from a broader perspective, our legislation with payday lender, it's very payday lender friendly here. There are not many regulations on payday lenders, so they can uncap their interest rates. So here's another question. Does anybody know what the average APY or annual percentage for the year is on a payday loan in Southern Nevada? What is the average? Does anybody know? Over the course of a year, what does that look like? Somebody said 23.99. Anything, 25, 200, 120, 70. I'm seeing lots of stuff here, 99%. All right, 60, 27. Guys, it's way higher than all of your numbers. Right now in Southern Nevada, okay, Dotton said 500%, that's about right. The average annual percentage rate on a yearly basis for a payday loan in Southern Nevada is anywhere from 400% to 600%. It's astronomical. And so here's what happens. I'll give you another example. We had a woman come in. Another woman, she made good money, but even though she made good money, she wasn't managing it the best and was paycheck to paycheck, not saving and that sort of thing. What made her come in was her daughter had asked her, this was prior to the pandemic, her daughter had said, Mom, I need cap and gown. And her mom couldn't even afford to get her cap and gown because so much of her money was tied up in payday loans. What had happened was she had an emergency situation. Her car got broken into while she was at work, and it was so severely damaged that she couldn't drive it. And this was her only means, her only transportation to and from work. So she needed to get it fixed, and she needed to get it fixed immediately. She called her insurance, and her insurance did not cover this. She was hoping her work's insurance would cover it because it happened at her job, but it would not cover. So she had to come up with the money herself. She didn't have it. It was about $1,500 in damages. So she went to her local payday lender. And this is a very good example of how this works. She went there and they said, oh, sure, you have income, so you qualify. You don't have to have good credit. That's the thing about the payday lenders. You don't have to have good credit, so we'll give it to you as long as you have income. She proved that she had income. They gave her the $1,500. They said, listen, if you come back in 2 weeks and pay it in full, you'll never even pay interest. Sounds like a good deal, right? They do that on purpose. They know that statistically, most people will not be able to pay the loan off in two weeks, right? It's a very small time to pay something off like that. So she came back in 2 weeks. She's like, guys, I can't pay this off. They said, that's okay. We'll just put you on a payment plan. So they put her on a payment plan where they were automatically taking funds from her account every single pay period, every 2 weeks. So what ended up happening was after doing this for a few weeks, it became too much because she was paycheck to paycheck. So now all this extra money was being pulled from her account. Now she's having a hard time paying her regular bills. So she goes back and she says, guys, we got to change something here. I can't pay my bills because of this loan. They said, that's okay. Here's another loan to pay off those bills. So you're not late, you're not delinquent, you're okay. And then we'll just put it all together. You just pay that. Now she has 2 payday loans. And now they're pulling more money from her account. By the time she came to see me, she had 3 payday loans. It's called the payday loan cycle. The average is actually 10 payday loans a person in Southern Nevada. It's a cycle. It becomes, people go there to get help, and then it ends up being a hardship. And so now she's paying these high interest loans. Here's the kicker. This is what we found out. She was spending over $900 a month on these payday loans, and they were interest-only payments. They told her that to keep the payments lower, they would just be interest only, and if she had extra money, she could pay it towards the principal. Again, they count on the fact that you're not going to put the extra money towards the principal because it's already expensive. So what happened? She was spending over $900 a month on nothing. The amount that she borrowed, that $1,500, was never going down. She was never touching the principal. So again, here's a situation where, because she didn't have the best credit, she knew she couldn't go get just a personal loan at a lower interest rate where she could pay it off. So she turned to the payday lender. She turned to somebody who said, oh yeah, we can help you with a short-term loan, but it ended up being a hardship and not a resource. So sometimes having bad credit can affect us in a way where when we need a resource, we can even be taken advantage of, especially in this town, because they're not heavily regulated. Now, somebody did say, somebody did mention that, you know, it's in certain communities, right? You see more payday lenders in maybe the Black community, or different communities, I should say, because the fact is, if you really take a look at Las Vegas as a whole, what you'll see is, if you're looking at all these payday lenders, you're not going to see them in Summerlin, are you? And you're not going to see them in Green Valley. Where they are specifically placing themselves is in what we consider LMI communities, or low to moderate income communities. So the average Joe who works down on the strip or whatever, wherever he lives is probably where there's more payday lenders. And that's just, it's unfortunate, but they do prey on the communities where people need those types of resources, but then they don't really offer a resource, do they? They offer a hardship. So the reason I bring this up is not only to stress the importance of what good credit can do for you, even in an emergency situation, but it's also to stress that, I apologize, I've got all these emails coming through. It's also to stress that, you know, with these types of situations, whether if you're in an emergency situation or not, you don't want to go to the payday lenders, guys. They have their great little jingles, and they're on every corner, and they want you to come in, but at the end of the day, they can really, really be a hardship, and they can really get you caught into a cycle that is very hard to get out of. Now, I will say this: we have a very good partnership with Nevada Partners, and we are offering a program specifically to just a few partners in the community. Nevada Partners is one of them. And one of the things that we're doing is we have it's called the Payday Loan Rescue. So if somebody is in a payday loan cycle and they don't know how to get out, as long as they can show proof of income, we can usually work with them and try to do like a consolidation and get them out of the high interest loan, loans, so that they can actually pay it off, and it's realistic. We were able to help that one woman out that I just mentioned, and she had the thing paid off in 3 months, which was great. And then because of that, she opened up a credit builder to start working on her credit, so she didn't end up in that situation again. I'm going to talk about the credit builder a little bit more in the end. But I hope we have a better sense now of why having good credit can be important. It's not just so we can have good interest rates and lower payments, but it can also help us in tough situations. The best thing to help us in tough situations, honestly, is a savings, to have a nice savings set aside, right? But if that's not something you have built up yet, good credit can definitely help you in a situation like that. So let's move on. Let's talk about credit scores. Everybody's always interested in their credit scores, and there is a difference between a credit report and a credit score. Okay, so what do I mean by that? A credit report is actually going to show very specific line by line items of the things every time you've put in an application for credit, whether you're trying to get a credit card, whether you're applying for an auto loan, whether you're applying for a personal loan, anything that you have to use your social for is probably going to show up on that credit report. Okay, your credit score is kind of a picture of what that big report looks like, because a lot of times when people are looking for your credit score. They don't want to read the whole report. Some people just want to see, oh, well, what's their score? That'll give us a kind of general idea or kind of a picture of what their credit looks like. And we can make a decision based on that for some, right? So here we see that if you have a 580 or less, your rating is considered poor. So all that means is that you want to try to get it higher than that, right? What that means is it's going to be challenging for you to get approved for a loan. And if you do get approved for a loan, it might be a high interest loan. For instance, the gentleman I told you about earlier on, where he had those really high interest payments on the vehicles that he had purchased, he was lower than a 580. They went ahead and approved him because of his income, but they gave him an astronomical rate because of this score. So he wanted to get it higher. He was hoping to get it somewhere in here, right? In the 670 to 739. Now the 580 to 669 is fair. This actually isn't bad. I know we as a credit union, we have provided different lending opportunities for people in this category. The interest rate isn't going to be our lowest rate, but we can usually help people here. Sometimes when you're in this score range, in the fair range, that's usually when a lender will look at the report now and see why it's fair. Is it because of something from a long time ago that just hasn't fallen off your credit report yet? Or is it something recent? That's what they're going to look for. They're going to assess the risk. So when you're trying to get a loan or a mortgage, right, the lender is looking at you, at your credit, to see how risky you are. So if they see poor, they're going to say, okay, this is, if their credit is this score, they're going to consider you risky, so they may not lend to you. If you're fair, they might dive a little deeper into your credit report to see why it's fair and see what that level of risk looks like. When you get into the good stage, anywhere between 670 and 739, this is not bad at all. You can get very, very good interest rates in this score area, particularly in the 700s. When you get to about 720, you can usually get some of the lowest rates. I've gotten I had a 720 right when I purchased my home and was able to get one of the lowest rates. Now, I will say, once I purchased my home, my credit took a dive for a minute, which it usually does, and then it starts to come back up. So that's something to think about. When you apply for credit, any kind of credit, your credit score will drop a little bit, just so you know. So that's one of the things that can affect your credit, and we're going to talk about that in the next slide. When you get into the very good and the exceptional, I will tell you, exceptional is hard. It's hard to get into 800 plus. Very good is a very good place to be, right? So this says you're above what the average US consumer demonstrates on their credit. So if you can get above 740, you're in really good shape. So let's go to the next slide and talk about the factors that contribute to this score, okay? Your bill paying history is the main one. The main thing that affects your credit score, I believe it's about 30% of all the factors, is your bill paying history. So if you're late, when you're making payments towards your auto loan, towards a personal loan, towards a mortgage, towards a credit card payment, if you're late, your credit score is going to take a ding. If you have just completely missed payments, your credit score will take a ding. Your bill paying history is huge. So usually what we teach, and you'll see this in another slide, but one good tip is that every single payment, your utility bills, everything, even though those don't really go towards your credit score, it's just good habit. If it becomes a good habit to pay everything early, then this is good for you. right? Because you're paying everything early. You're not even paying it on time, you're paying it early. If you can get into that habit, that's going to help your credit tremendously, because you're paying everything early, not just a couple of things. Like, you've prioritized all your bills. So this is where budgeting comes into place. I do a whole workshop on budgeting. If that's something that maybe you're struggling with a little bit and you think that that could help you with this area in terms of your credit, I can chat with you about that offline, but or with, I'm sure, one of your counselors through this program. But budgeting can definitely help you with this particular factor, because you want to budget your money to be available for your bills early. So you have to plan for that. You have to budget for that, right? So we want to pay our bills. We want to pay our expenses on time. I always say pay them early. So you have to plan ahead to be able to do that. Another one is your current unpaid debt. So they're going to look at this. Kind of has to go with this one. Current unpaid debt kind of also goes with this one, how much of your available credit you're using. So they're going to look at your balances versus your limits. So let's say, for instance, you have a credit card with a limit of $5,000. Okay. There's a part of the phone number missing. Oh, I apologize. I see. So let's say you have a credit card with a limit of $5,000. Let's say you have a balance of $3,000. You owe $3,000. That can actually hurt your credit. The credit bureaus really like to see your balances versus your limits at about 30%. So what's 50% of 5,000? 2,500, right? My math's not the best. So if it's $5,000 times 0.30, $1,500. Okay. So if your limit is $5,000, the credit bureaus want to see you under 1,500. They don't want you to go over 1,500, because you're using too much credit in their eyes. So when it says this is your current unpaid debt, so they're looking across the board. How much unpaid debt do you have? Like, let's say you have 5 credit cards, a personal loan, 2 auto loans, and something else, and you owe a big chunk on all of them. That's a lot of money to owe on your credit. So they'll look at that, and that can hurt your credit score. So what would it look like to be good? If you have to show that you are, this is how the credit bureaus look at it, to show that you're like responsible with your credit, they want to see a few different forms of credit. So maybe just 2 credit cards, maybe 2 auto loans, and a mortgage. That's not bad. But what are your limits versus what are your balances versus your limits? When you purchase a vehicle, let's say you're purchasing a vehicle that is $15,000. When you get the loan for that, the loan is for $15,000. So that shows that you're maxed out on a loan. So that's why your credit takes a dip when you get a loan like that. But it comes back up. You start making payments, it comes right back up. But the point is the credit bureaus look at that. So they want to know that you're at about 30% or less in terms of what you owe versus what you can get. So if you've maxed out a bunch of credit cards, that's one of the things that can hurt your score. The number and type of loans accounts you have, which we just touched on. So if you have like 5 different credit cards and 3 auto loans, and you're trying to, you just bought a boat or something, these are the types of things that it starts to build up. It's a lot. And so that can hurt your credit, because now it shows you as risky. You are, if you're going and applying for different credit cards all the time, for instance, let's say you go shopping. It's Saturday and you want to go to all these stores. So you go to TJ Maxx, and you go to Target, and you go to Best Buy, and you go to wherever else. In all of those stores, 9 times out of 10, they're going to ask you if you want to apply for their credit card for a 5% discount or something like that, right? If you start, so let's say you do that, you're like, oh, sure, I'll apply for that. Oh, sure, I'll apply for that. And in one day you apply for 3 different retail credit cards, what's going to happen? The credit bureau they're going to look at that and say, oh, why he or she, why are they applying for so much credit? Something's off here. So it's like a red flag to them. That makes you look risky. So it's not something you want to do. And another thing to keep in mind, just so you guys know, retail credit cards are the worst credit cards in most cases because their interest rates are always higher than a regular Visa credit card, just so you know. Now, sometimes it can be helpful if they're doing like 24 months, no interest, and you know you're going to be able to pay this thing off in 6 months or something like that. That's not a bad deal. But if you're not sure how that's going to work, how you're going to be able to pay this off or whatever, and then all that credit comes or all that interest comes, I'm sorry, and hits because you didn't pay it off in that timeline, ooh, that's hard. That's not good. So it's important to know these types of things, right? When you're looking at credit cards, when you're looking at applying for credit, how that affects your score. And just so you guys know, once you start a home buying process and you've applied for a mortgage loan, that whole process can be anywhere from 6 to 8 weeks or whatever it is right now. During that 6 to 8 week process, you cannot apply for anything. You can't use your credit for anything because it can affect your loan, your mortgage loan. I've seen people in that 6 to 8 week period, they've applied for their mortgage and it's going through the process. And then right before closing on the home, they go and apply for all this brand new furniture that they want to put in the house. And then they get denied for the loan at the last minute because they did that. Hurts their credit. So you want to make sure that you're good there. You don't want to be applying for things during a home buying process. So just something to think about. And then the other thing that you need to really be aware of is whether you've had a debt set to collections or foreclosure or bankruptcy. These types of things also affect your credit score tremendously. I will tell you that a bankruptcy, even though it affects a bankruptcy really affects your credit report. It doesn't always affect your credit score negatively, not always. It's interesting how that works. Sometimes it can actually help your credit score, but I don't recommend bankruptcies for a lot of reasons because even though your credit score may not always take a dive when you file a bankruptcy, it goes on your credit report. And as soon as a lender sees that, oftentimes you look very risky, right? So I don't recommend bankruptcies. There's a lot to know about those. If you have questions about it, let's say this is something that's been on your mind, or maybe you've had a bankruptcy in the past and you want to know how that's going to affect you or affect your home buying process. That's another thing that we can talk about offline, or you can even ask towards the end when we have our questions and answers. But they can affect your score just like they can affect your report, your credit report. So let's talk about the credit report now. There are 3 different credit bureaus. There's Experian, Equifax, and TransUnion, okay? You can request a free credit report every year from each of these bureaus. Our preferred method to people is annualcreditreport.com. You can go on there and you can request a free credit report, and they can do that for you. Now, here's the thing. When you request a credit report, if you go directly to the bureau and do it, I believe Experian has a really good app. So you can join that app and actually monitor your score pretty well through them. But if you request it individually, you can stagger it. So what do I mean by that? I mean, you can get a free copy of your report from Experian in February, and then maybe in May, you request another one from Equifax. And then maybe in October, you request one from TransUnion. Well, why would you do that? Well, if you're working on your credit and you're trying to get your score up and trying to work on that credit report and clean it up, you're going to want to see how it's doing. You want to make sure that everything's up to date. And so if you stagger it throughout the year, you're getting these free reports multiple times throughout the year. So that's a good way to do that. Why is it so important to look at your credit report? Everybody focuses on the score, right? So why is it important to look at the report? sometimes when you look at your credit report, and I believe this is on the next slide, stagger your requests. We just talked about that. Yeah, here's what I want to talk to you about as far as a credit report. You need to be able to review the information very specifically and take your time. And the reason why is because it's very easy for the credit bureaus to make mistakes, and they do it all the time. There's a lot of reasons for this. Let's say you go to Ashley Furniture. No, let's say somebody else goes to Ashley Furniture and they have a social security number that is very similar to yours, but maybe it's just one number off. And they apply for credit, and the person at Ashley Furniture enters the wrong number. And now it's on your credit report. I've seen that happen. And people don't, of course, you're not going to know that if you don't check your report. Okay. Another thing to look for is, do they have the right name? Are they spelling your name correctly? Why is that important? Because there could be somebody else who has a similar name, and it can confuse the system, and some of the things from their credit report can land on yours. I've seen that happen, right? So, and then sometimes if you have other issues on there, like social security issues or something, if that information is not correct and you're not checking this regularly and disputing items that are wrong, then when you go to apply for a loan and they see this on your report, they're going to say, whoa, this is risky. We, even at a credit union, we can't even open an account for somebody when they have what we consider what is called a social security variance. So if it looks like they've used their social security, if they've used different social security numbers, that's a variance. Sometimes folks will use their children's social security numbers to apply for credit because there's a shot. I don't recommend that. That's fraud. You don't want to do that. Sometimes I've met young people who didn't know that their parents had done that with their social, and they had to start from scratch. These are things to be aware of. You really want to check and make sure that stuff is cleaned up on your credit report. It's very, very helpful when you're applying for loans, especially when you're applying for mortgages, right? Because they're very detailed in what they're looking for. So then you say, okay, so how do I dispute? I have a form, and I can share it with everybody. I'll share it at the end, but I have a form, and I got it from the CFPB's website, so you can get it from there too, but it's a fillable PDF. So if you're going through, there's a checklist I can give you so you know what to look for on your credit report. And then there's also a form where you can, basically it's a letter, so you can just type in the missing elements in the letter that are specific to your situation, what you're disputing, and you send it in, okay? But it is important that you dispute things when they're incorrect. But you're not going to know if you need to dispute anything if you don't review that credit report. That's something we definitely got to do, especially before we're applying for a mortgage loan. So let's move on to the next slide. Okay, let me give you some quick tips, and then I want to talk about the credit builder a little bit, and I want to answer some questions, okay? So how do you improve and maintain good credit? You want to pay your loan payments and utility bills on time, every time. So again, we're just creating a good habit. We're paying everything early or on time. We want to try to pay it early though. So just create that good habit. If you don't already, or maybe you're trying, maybe you feel like I try to pay things on time, but sometimes it just doesn't seem to be working for me, or I don't know what happens to my money, like why I can't seem to get this right. Sometimes that habit needs to be established with a budget. If you're managing a budget regularly, here's the thing. Let me step back and say this. There is a difference between budgeting and managing your money. A lot of people say that they budget because they have a list of their expenses and a list of their income for the month, and they say, okay, I've got a budget. That is very different from somebody who's actually managing their money. If I work at Taco Bell and I'm the manager at Taco Bell, guess what? I am constantly watching them make the food. I'm watching them at the register. I'm talking to customers. I'm managing at all times, right? That's what managing is. It's your money, guys. You earn this money, so manage it, right? So what do I mean by that? I mean, you're looking at your budget regularly. You're looking at your bank account regularly. You're making sure that they match up. You're making adjustments where needed. You are managing your money. If you're managing it well and you're doing this, then you should be able to get into a habit where you're paying things early, right? Because that's what's going to help your credit. Really, really going to help your credit. Don't max out your credit lines. Keep your balances at 30% or less. Pay off credit card balances on time every month. Again, so you're paying things on time. Listen, I know sometimes we're like, okay, well, I don't want my power to get shut off, so I'm definitely paying that first, you know. But if you really are working on your credit, you have to definitely make anything that is affecting your credit, like a credit card bill or an auto loan or something like that. You want to make sure that those are priorities. They have to be priorities, because if you put them, if you make them not a priority and you're not really, you know, you're kind of flippant about it, then they're not going to get paid on time, and that hurts your credit. Only apply for what you need. So again, if you're at Target and they say, have you applied for a red card yet? You'll get 5% off your discounted off your items today. Don't do it. You don't need it. You really don't. You're gonna take a ding on your credit when you do it. 5% is not that big of a deal. And usually once you have that credit card, now you're gonna be tempted to spend more, right? So maybe not the best thing to do. Check your credit report regularly. Dispute incorrect items on it. Again, that's a big part of managing your money. When you're managing your money, you're also managing your credit. You got to look at that report. You got to manage that, make disputes where necessary. And I'm going to show you how to do that. And then use credit building products. If there's a good credit building product, like what I'm about to share with you, that can help speed up the process. You're like, okay, I'm already there, Emily. I'm managing my money better. I'm paying things on time, but I'm still at like a 600 and I'm trying to get to a 700. What can I do next? Okay, that's what I want to talk to you about. Ooh, there's products and services that are actual resources to you. So let's talk about that. First of all, you're going to want to have a checking account, right? It's a great place to manage your money, and make sure your checking account is free. If you have had issues in the past with managing money or overdrafting your account, get something like what we have. We have a free checking account that we call checklist checking, and it's a checking account that does not allow you to overdraft. So what that means is if you go to use your debit card and you thought for sure you had $50 in there, but maybe something pulled that you forgot about, and now you only have $30 in there, and you go to make a $45 purchase, it'll just decline your card. It will not let you overdraft your account. Okay, so that's something you wouldn't have to worry about with an account like that, if that's something that you think could help. And then you set up something like a credit builder. So I'm gonna pull up another item on my screen real quick. This is what a credit builder looks like. Okay, so I'll just read it to you real quick, but we get it, life happens. Sometimes your credit score might need a little help. We want to get you on the road to financial success. Our credit building loan is one of the best ways to build credit. It's designed to help those with no credit, or if you have colorful credit. The program focuses on building or rebuilding your score while helping you develop good savings habits. So what does that mean? Most people think, I'm actually going to unshare my screen so we can just chat, and then we'll open it up to questions after I explain what this is. So I'm going to stop the share. Okay, so here's the thing. Most of the time when people think that they need to rebuild their credit, they will apply for a credit card or use a credit card and then go have to make purchases that they don't necessarily need just so that they can make a payment on it and build their credit. Our way is different. This way, instead of having a high interest rate from a credit card and purchasing something you don't necessarily need, we will actually help you build a savings while you build your credit at a very low interest rate. So our credit builder is open to everybody. The interest rate remains the same. So if you have a 300 score credit, you're still going to have a 5.5% interest rate. Our credit builder is a 5.5% interest rate. So most credit cards are anywhere from 12 to 25% in interest. Our credit builder is 5.5% no matter what your score is, okay? And this is how we do it. We as a credit union take our own money and we put it into an account with your name in it, like a savings account, okay? Let's say we do $1,000 over the course of a year. Then your payment ends up being like $85 a month. Okay. And this is just an example, and the cool thing is we can be flexible depending on what your affordability is. Like, let's say, well, I can only do $50 a month. Okay. We can work with that. We'll put a different amount in your account. And you can pay it off in a certain amount of time. But the point is if we do this over the course of a year, you are paying towards your own savings, but we're reporting those payments to the credit bureau. And so you are building a savings and building your credit month after month. Okay. It's a very, very safe way to build your credit. And on top of that, at the end, that money is now available to you because it's your money. You paid towards it, right? So now at the end of 12 months, you have $1,000 sitting in your savings account. So what we talked about earlier on about needing money in an emergency situation, now hopefully you won't even need to use your credit in that situation because now you've gotten into the habit of building the savings. Or maybe that savings is helping you with the purchase of the home. But either way, it's a really, really great opportunity and a very safe way and a low interest way to build your credit and build savings at the same time. So that's the program that we want to offer to you guys as a help. I'm going to open this up to questions. We have a lot of, I have a lot of things that I want to share with you guys, some documents that I will post in the chat. I'll post a flyer of this credit builder. I will post some handouts about disputing things on your credit report and even a checklist for that when you're looking at your credit report. And then I'm also going to put a link. So I'm going to put a link in the chat. And what that is it's a sign-up form that only I can see. So a lot of times when we're on these forums here, it's a little public. And so we don't want to always ask the questions that we want to ask because they're personal, but we want answers. I encourage you to go ahead and ask the questions because it might help somebody else in the group. But if it's so personal and you feel uncomfortable, you can click on the link to this form and you can ask me that way. And I can just reach out to you and answer your questions and help you. So I'm going to give you two options there. So I'm going to go ahead and do that. And I'm going to open this up to questions. Let's see here. I see some stuff coming in. How do inquiries affect your credit score? I'm going all the way back. So every time you inquire, every time you do a credit check, they say, oh, that's a hard check or that's a soft check. A credit, when your credit score is affected is anytime you apply for like a new credit card, a loan, whatever, it takes a little bit of a dip every time you do it. So now I will say this, when applying for a mortgage, usually if you're like shopping for a lender or something like that, usually if you apply at like, if they do a check 3 different lenders, but it's all within a month, it should only be one hard inquiry against your credit so long as it's within 30 days. But when you're applying for different credit cards and stuff like that, your credit does take a little hit. Send me anything. Okay. Is there any help with student loans? That's a great question. I have a whole handout on student loans and it is very, it's very helpful. It's it's a lot of information in it and it should be very helpful to you. I could spend a whole hour talking about student loans, but we don't have that kind of time. But I'll post that in the chat as well. How will paying off credit cards affect your score? That's a great question. So it depends. If you pay it off and it's at a 0 balance, that's fine. That's great, actually. But if it just sits dormant and you never do anything with it, then that's all it is. It just looks like you have available credit that you're not using. But it depends on how many of these credit cards you have and how many you've paid off. Usually if you close out a credit card, your credit will take a little bit of a dive. But everybody's different, right? So if you're worried about your credit right now, you probably don't want to close out the card. Paying it down or paying it off is not a bad thing, but I would not close it out while you're trying to build your credit. Once you've got your credit built and you don't want to have maybe that temptation, then you might want to close it out at that point. But it depends on what your needs are right now. If right now your main goal is building your credit, then yes, you want to pay it down, maybe even pay it off, but don't close it out. Okay. I have a lot of credit cards that are paid in full, but I no longer use it. Is this hurting or helping? Should I just close them? Again, so if you're trying to build your credit, I probably wouldn't close them out. What you might do is maybe go take 2 of them. And here's what I say with credit cards. This can help your credit. If you've paid them down to 0 and you're really good at managing your money and budgeting and that sort of thing, use maybe 1 credit card for gas and use 1 credit card for food. If you're managing your money well, you've already budgeted what you're going to spend on food and gas. So you basically use the credit card as cash. So you go and you use the credit card for gas for the month. You use the other credit card for groceries. And then at the end of the month, pay them off. So you never really paid interest, but you're showing usage, and that helps. Does that make sense? So that's a good way to use credit cards if you've paid them down to 0. And by the way, if these credit cards are like a rewards cash, you're going to actually earn rewards from the credit just for using it, which is kind of a cool thing. But if you're somebody who struggles with credit cards and you're afraid of, like, once you start using it, you'll probably keep using it and then you don't pay it and then it becomes an issue, don't do that then. But only if you're good at managing your money and you're budgeting really well, and you say, I have this amount set aside for food, I have this amount set aside for gas, then you use those amounts to just pay the credit cards. But you're using the credit cards and it helps your credit because you're paying it off, right? How does getting a credit card work while still in a bankruptcy? Here's another bankruptcy. I have a bankruptcy. How does that hurt me? So bankruptcies are complicated. It depends on what I'd have to do is find out what type of bankruptcy you have, and then we'd have to determine how long you've had the bankruptcy, and then you can get credit cards when you have a bankruptcy. You may not get a great interest rate, but you can get them. So it just depends on what. Again, I don't know that I'd recommend it though. I'd have to really look at your situation. These are good questions, but some of these are very one-on-one kind of questions because it's going to be specific to what your goals are, and then what the terms of those bankruptcies are. So I'd love to give you a very general answer, but it's a specific thing because there are different types of bankruptcies, and it just depends on how long you've had it. If you have a 580 minimum for an FHA loan, is there anything that can disqualify you even if you meet the bare minimum credit score? Great question. Usually, and again, some of these questions will be answered with some of the counselors that are going to help with the home buying process. But what I can tell you is usually lenders are also looking at your DTI or your debt to income ratio. They want to make sure that you can actually afford the loan. So they want to see what you're already paying on. Usually they like to see you at 40% or less, but I haven't looked at the updated qualification, so don't quote me on that. Maybe a good question for one of your home buying counselors, but that is another thing that they're going to look at is your debt to income ratio. How difficult is bankruptcy with buying a house? Again, it depends. It depends on how long you've had it, what kind of bankruptcy you had. I know that with a foreclosure, it's harder. There's a little more leeway with the bankruptcy, but it depends on the lender too and what they're comfortable with. So that's something that you would want to talk to your home buying counselor with. FICO score 8 versus FICO score 2. Can you high level explain the difference? An 8 versus a 2? I'm confused on that one because the scores are in the hundreds usually. So Michelle or Michael, can you clarify on that a little bit more? What you mean by that? Should you settle or pay off collection? Great question. So for collections, you want to pay it off as soon as possible. When there's a collections on your credit report, that really hurts your credit score. When you get it off, it helps your credit score. Collections really hurt your credit report, so you want to get that off as soon as possible. If the collection agency is offering you a settlement, that's not necessarily a bad thing. You can settle, but you need to be aware of a couple things. If you settle, whatever the difference is from the amount that you owed versus what you settled at, that difference can be counted as income towards you, and they can tax you on it in the next tax year. So just keep that in mind when you're looking at settlements. And then just so you also know, when you're dealing with collections, you have to make sure you get a statement from them that says it's paid in full, that you're done. It's called a payoff statement. Get a payoff statement from the collection agency. Why? Because if the credit bureaus don't get that information from them, then, after so many months, you can go to the credit bureaus and say, no, I paid this off. Here's the documentation. So you want to have documentation for everything to help with that. What do you recommend to be the first step in rebuilding credit? It depends. It depends on where you're at, right? So usually I tell people, if you have something in collections, that's one of the first things you want to do is pay that off. If you've maxed out credit cards, you're going to want to start to pay those down. And then once you start taking care of some of those items, then you start looking at like a credit builder, because now it's affordable to you too, because you've paid things down, you've gotten rid of a collections, these types of things. So a credit builder can help you, but you have to kind of get some of those other things in line first, like making sure you're paying everything on time, making sure there's nothing on collections, and trying to pay down some credit cards or whatever. But again, it depends on the person and what their financial portfolio looks like, right? So if I pay down debt, is it better to wait till credit score updates, or can zero statements suffice when getting approved for a mortgage loan? How can you pay debt? Is it better to wait till credit score updates, or can zero statements suffice when getting approved? What do you mean? If I pay down debt, is it better to wait till the credit score updates? Or, oh, I see what you're saying. It depends on the lender and what they're comfortable with. So sometimes they really want to see it change in the credit report. But sometimes some lenders are okay with, if you bring statements showing, no, I paid these things off. It hasn't, showed yet on my credit report, but here are these statements and they're paid off. Some lenders are more lenient than others. So it's really going to depend. I hope that answers your question. How can you stop dealership from slamming your credit with inquiries after you don't buy with them? I had 49 inquiries after leaving United Nissan after I said I was just looking. BB said they couldn't do anything, but it's on my reports. No kidding. I have never heard of a dealership do that before. That is horrible. Well, I can't tell you what to do about what happened in the past, but what I can say, because I think this is a helpful question for everybody. If you're just looking to purchase like a vehicle or something like that, what you may want to do is do your own research first. So what I mean by that is, if you are managing your personal finance and you're looking at your credit report, every few months or whatever, you should have a pretty good idea of what your credit score is. And then you can kind of do like, you can go online and look up auto loan calculator and input what you might be able to do. And then if you're so that way, when you go in, you already have the information you need. You're not giving them your social to run your social and do the work for you, where they're saying, oh, you could afford this car, your social is this. You don't want to give them that power. So if you're working with a credit union or your bank or whoever you're working with, you can, even after you do that information, then apply for an auto loan. They'll tell you exactly, okay, you could get a loan for this, and this is what it is. Now you've only had one inquiry with your trusted financial institution, and then you can go make a purchase using the loan that you got with them. That's usually the best way to do it. Sometimes you can even have like a check from them for your auto loan before you even go. I've done that myself before. It was very helpful. As of now, I have one account on my credit. Should I open up another while in the process of buying a home? Again, it's going to depend on you personally. So I don't know what the rest of your finances look like. So, or what you owe on that credit line, what the balance is to the limit, and what you can afford. What I would do personally at this point, since you have one thing, maybe now open a credit builder, because that's a safe way to add something on. So if you can afford whatever you can afford, if you can afford another $50 a month payment or $100 a month payment, maybe open a credit builder. Okay, how do you get rid of duplicate reports? Can you help me understand what you mean by duplicate reports and how that's affecting you? Does Payday Loan Rescue also help with title loans? Yes, yes. In fact, quick example, I had a woman during the pandemic, her and her husband lost their jobs. Their car was paid off. She got a title loan online. These online it was bad. She had 150% interest rate on a title loan. Title loans are supposed to give you lower rates because you're backing it with collateral. But a lot of these places are taking advantage of people, and they're still doing these really high interest rates. We were able to consolidate that into an actual title loan with a low interest rate, and she's almost paid off already by now. So if you've gotten into trouble with a title loan too, we do know that they're doing high rates, and it's really not fair considering the fact that, you know, if they have your title, you've backed the loan with collateral, so it doesn't make sense for them to do these super high rates, but they will. So if you need help with that, yes, we might be able to help you. I have paid all accounts on time for 5 years, but I have closed accounts from 5 years ago. My score hasn't increased the entire time. What can I do to raise my score? Again, I would have to look at your personal finance, like an overview, and kind of understand. You said you paid all your accounts on time for 5 years. I would have to see what that usage looked like and what's going on with that, why it didn't go up or down or anything. But I would recommend right now, if you want to raise your score, open a credit builder. It's safe, it's effective, and you have savings at the end. So that's why I always say that. Is SCE local to Nevada only? No, we are also in Southern California. SCE used to stand for Southern California Edison, because we used to work primarily with just Edison employees in Southern California. But we've opened up our membership to everybody, and we've come out here to Southern Nevada. So we're in Southern Nevada and in Southern California. On Experian, Fico score 8. My score is 662. How accurate is their scoring? Experian is one of the best. Experian is used the most by lenders when they're looking at stuff. I believe the different bureaus focus on different things, but people primarily use Experian, so it's not a bad one. It's pretty accurate, and 662 is not bad at all. What is Advantage's core? I have no idea. I'm sorry, I wish I do, but I have no idea. I'd have to look that up. Oh, okay, here we go. Lisa answered the question. Good. There's several scoring techniques. Okay, I see. Can you explain the difference between FICO and Credit Karma, Credit Sesame? I mean, so basically what there are different sources out there to check your credit. A lot of them, a lot of them turn to the credit bureaus to get your information and give you fairly accurate scores. But the reason why there are so many is because they've turned it into a way to make money. It's a business for them. So if you want to check your score regularly or whatever, then you got to get a subscription with them, right? Or something like that. So a lot of times they're pulling their information from the same bureaus that you'd be pulling it from, but there's usually a cost to it. Whereas you could do it directly to the bureau yourself. You know what I mean? So that's the difference. And then some of them will have add-ons like, oh, we'll help protect your credit by, if we see something odd, we'll let you know and notify you. So again, I mean, there are services that can help do it for you, but they're going to charge you when you could do it for free yourself and just review your own credit score regularly. And that's what I always recommend. I see in Experian, they say they have a FICO score model 8, and I have read some lenders use FICO score model 2 with home loans. Maybe I am confusing myself. Yeah, Michael, I gotta be honest with you. I don't spend a lot of time on those different scoring models. I look at what the one I showed you when we were going through the slides, where it says 580 or less and so on and so forth, because that is what the credit bureaus use. And it's easy for me to understand knowing that that's what they're using. So that's why I spend more time on that. But so I don't really know how to answer that question, because I don't spend a lot of time on those particular models. So because I don't know a ton. Payoff statement and even better deletion letter. Okay, great. Oh, Lisa's saying this as well. I think that's what they're referring to. How do you get a paid collection account off your credit report? So again, you want to get, if you've paid it, you have to ask them for a statement, a payoff statement. And then once you have that, you submit that to the credit bureaus and say, I paid this off, please. And you ask them, please remove this from my credit report.
Okay, Emily, thank you so much. This was just amazing. Great, great, great. Thank you. Credit, we know, especially in low to moderate income households, which typically are brown and Black households, credit is a huge factor and hurdle of why we are not able to get better interest rates, to qualify for mortgages. And so we are here to tackle the hurdles to get you where you need to be. Our next event in our series is March 27th at 1 o'clock. That will be a panel discussion. So we will be discussing student loans, bankruptcies, foreclosures, as well as credit hurdles. So when we talk about the questions you had on mortgages and what makes sense for in order to get a mortgage, those are the things that we will be discussing next week, along with any other hurdles that we typically see in the community that keeps us from being able to purchase a home. So that next session is March 27th. You will receive a link for that, as well as a reminder from your housing counselor, whoever you have signed up with. They will be able to do that too. We'll also be reinforcing some of this particular credit builder, as well as a couple other options that we have for credit and building credit from the standpoint of what a lender needs it to look like. We'll also talk about some tax hurdles, especially for our self-employed people who do not have a normal W-9 income. You can sometimes have hurdles in the way of taxes. So a lot of times we write off everything, and then we come around to purchase a home and it looks like you've only made $12,000 for the whole year. So we will be talking about some of that as well. Thank you so much to all of our coalition partners, Nevada Partners, AmeriFirst Financial, NID Housing Counseling, Nevada Association of Real Estate Brokers, Neighborhood Housing Services of Southern Nevada, NACA Community Services of Nevada, and Urban Chamber. Sorry if I forgot anyone else, but we thank you so much for the opportunity to meet with you all. We will see you in 2 weeks. At 1 o'clock, we will be talking about all of the hurdles to purchasing a home. And thank you so much for the creators of this coalition and spearheading everything, and that is Homey. So we are very, very happy for that. Next steps would be, I see Kina, you need to talk to a housing counselor. So we will go ahead and get with you shortly and get you signed up. If there has been any issues you haven't been able to, you haven't been able to get with a counselor, whatever that is, please send us a message now so that we can get you set up and addressed. So besides that, thank you so much for everyone. Elias has put in the link to schedule a call with your housing counselor. So go in there. We have lots of availability next week. We will get you scheduled. Again, if you need a counselor, Elias just put in there in the chat exactly what you need. So we will keep this open for maybe another 5 minutes just for questions. If you want to put it in a chat about signing up with a counselor and everything. In the meantime, Elias, can you give us some music? And we'll keep this open for about 5 minutes so that we can address some of your housing counseling issues in the chat. Thank you, everyone, and we will see you again in 2 weeks.